to position our Sharia offering and to have a bit more of an in-depth discussion around some of the macro factors that are affecting the portfolios that we look at in terms of what happened in the month past. Then we take one stock that contributed to the success of our portfolios. We discuss why we are holding it. And then we look at one of the stocks that actually detracted from the performance and what we are doing about it, or what our position is regarding it, and give some feedback on that specific detractor. So you will notice it's only 2 stocks. And then we wrap up the session and highlight 3 things, maybe 2 to 3 things that we are looking ahead in terms of macro factors, geopolitical risks that could affect our portfolios as well as the economy as a whole. So it's a very short 20-25 minute conversation. It's not a presentation, it's a conversation. And the purpose of it is to make you able to understand our thinking and our process more than just a return document and a very lengthy in-depth analysis. We do have sessions that we do that. Portfolio pulse is exactly what its name implies. It's just a pulse, which is a quick tidbit of information that's relevant, that you could relate to, and that is decision useful as well. So that's the purpose of these sessions. So if you have a question, just put it in the message box, type it in, and we will facilitate and answer those questions at the end. But generally, it's game on for any type of question that you could have. Imtiaz can do these questions off the top of his head. He is one of our directors, the portfolio manager with us. He's a CFA charter holder. He will be doing the session for us. And he's also the head of our Sharia propositions. So when we do Sharia roadshows and things like that, Imtiaz will be the person that will be leading up and heading up those presentations along with me in the background, gathering all the contact details and keeping in touch. So without further ado, I see Imtiaz already shared. Imtiaz, over to you, and I will put off my camera and I will get back in at the end of the session to wrap up and to answer any of the questions that you guys may have. But like I said, put it in the chat box and we will look after it and answer you. Thank you very much, Imtiaz.
Oh, thanks, Verlin. Thanks for that introduction. And good morning. Assalamu alaikum to everyone on the call. Thank you for joining us this morning. As Verlin mentioned, it's going to be a brief overview of our thinking with regards to how we see the macroeconomics situation playing out, what are some of the contributors and detractors to the portfolio, and how we're positioning the portfolio for the way forward as we see it. So it's going to be a brief presentation. We'll leave some time at the end for questions and answers, and please make it worth your while and ask any questions that are on top of your mind. From a macroeconomic perspective, we're living in a world that is being dictated by lots of geopolitical concerns, liquidity, and the actions by central banks. We're living in a world that is multipolarity. And by that, I mean that you're seeing a world that is dividing into different factions. And this is coming out of the wave that we had in terms of globalization since the early 1990s. And that's changing, and changing quite rapidly. So interests are being realigned, countries are choosing their allies, and we're seeing that the world is essentially breaking up into these factions. What does that mean? Overall, and top of mind is what's happened since COVID, especially in the US, and the huge amounts of liquidity that's been pumped into the system. That is now starting to reverse. Essentially, what we had in terms of zero interest rates was an anomaly. And what we're seeing now is a normalization of monetary policy. We might have thought that zero interest rates were here to stay for longer. And this has been backed up by countries issuing bonds for 100 years plus. but the situation is normalizing. And what we're seeing in terms of inflation, locally and globally, is that inflation is starting to accelerate. Although it has come down, the rate of deceleration has started to slow. And this has major implications for monetary policy. So the initial wave of the surge in inflation is over. What we're seeing now is inflation starting to settle down at around a 3 to 4% band. And we know the Fed has set their target for 2% inflation in the US, but it's going to be a massive challenge to get inflation down to that 2% level. The main contributors to not getting inflation down to 2% as quickly is labor costs. We've seen a very robust labor and employment situation in the US. The US is at record lows in terms of unemployment, and we've seen on the back of that wage pressures that are running above that 2% level. And this is one of the concerns that the Fed has to deal with. You've got a very robust economy, and we haven't seen the US go into a recession just yet because of this robustness that we've seen. But some of the drivers for the strong growth in the US are starting to wane. For example, the massive amounts of savings that was built up during the pandemic is now largely used up. If you look at the top 80% of the US consumers, their saving levels are now below those that of pre-pandemic levels. And those are the consumers that really do spend. The top 20% are the ultra high worth net individuals, and their spending power does not translate, much into economic activity. So on the back of that, we're seeing some pressures come through. The Fed has also hiked rates quite aggressively. We haven't seen the impact of that rate hikes come through as strongly as one would have thought. And there are a few reasons for that. The one is that a lot of those mortgages that were taken out during 2020, 2021, and 2022 were done at rates that are much lower than current rates. So if you look at average mortgage rates 3 years ago, they were at 2.9%. The median house price 3 years ago was $300,000. Fast forward to today, we've got average mortgage rates at 7.2% and the median house price at over $400,000. And this is going to have implications for inflation or asset prices in terms of housing and asset values. So there's massive amounts of stress that we haven't seen yet, but we think that as mortgages, loans, corporate debt has to be rolled over, you're going to see a ratcheting up of interest costs, and this is going to start putting pressure on the economy, especially in the US in general. So on the back of that, what does that mean for the different asset classes? Certainly for equity, it's going to be a challenge for corporates to grow their profits. And on the back of that, it will be difficult for PE multiples to expand further. So we're almost in a situation whereby you need either very strong earnings growth to propel the market further, or you need monetary policy to come down and support multiples at these current levels. Both of those variables are going to be a challenge. And for that reason, the way we're looking at the portfolio in terms of positioning is to have a bit more of your yield assets over risk assets. And we'll look at some of, the different types of asset classes and positioning that we currently have in the portfolio. Just to go in terms of what we're looking at for the different asset classes and some of the contributors in terms of stock contribution. One of the stocks that we have a positive bias to is Sasol. Sasol is, something that we know as a beneficiary of the higher oil prices. But it's not just an oil company. Sasol has made a few acquisitions in the chemical space, and chemicals are now a bigger contributor to its earnings and profits than oil. And it's one of the reasons why Sasol doesn't react as positively to a higher oil price as some of the pure oil plays that we have listed globally. But from a valuation perspective, we do see Sasol trading at an attractive multiple. It does benefit from a higher oil price, and we'll go into some of the oil dynamics in a few slides. But we do think oil prices at $90 and above is very positive for Sasol and its earnings outlook. In terms of the chemicals, there's been, Sasol manufactures chemicals and more in terms of the specialized chemicals. And these chemicals go into different areas of production, whether it's consumer goods such as shampoos, for example, cosmetics, and some of the industrial users like paints, etc. That has been under pressure as consumers have shifted towards generic use and generic products over some of the branded products due to inflationary pressures. But nonetheless, we do see the higher oil price, the weaker rand, being quite positive for Sasol. And it's also one of those stocks that acts like a hedge in times of uncertainty. So we've got the war in the Middle East currently that's supporting higher oil prices, and that should bode well for Sasol ultimately. So on the back of that, we've got 31% upside with a target price of 346 Rand for Sasol. And it's one of the attractive opportunities that we're finding at the moment. A stock that hasn't worked out over the last few months has been MTN, and there's a few reasons why MTN has come under pressure. The one is that, the macroeconomic situation in Nigeria has been tough. So earlier this year, we had the Nigerian elections. There were some uncertainty as to how that would play out, but it did go as expected, and there's been some reforms that the new president has brought about. The first major reform has been the devaluation of the naira. The naira was pegged at levels that was unrealistic, and the black market trade of the currency was at much higher levels. So we've seen a devaluation of the naira to some extent, but that still hasn't sorted out the lack of dollar liquidity in the country. And Nigeria has been suffering from a lack of forex liquidity, which makes it difficult for an operator like MTN to repatriate dividends. What we see is that at a higher oil price, some of those forex pressures will start to abate because Nigeria is an oil-producing country, and they will benefit again from a higher oil price. Some of the local factors that have affected MTN is the likes of load shedding. When we have higher stages of load shedding, the MTN towers and all of the telco towers are affected because they run on electricity, and the backup power at times is not sufficient to keep those towers up and running. So network quality effectively comes under pressure. But we've seen a lot of investment by the telco companies in terms of putting additional batteries, putting solar power and backup power at these towers to make sure that they can run for 4 hours and longer. But we've seen a step down in load shedding so far, and if these levels and lower levels of load shedding persist, that will bode well for incremental earnings, as these companies don't have to spend as much on the likes of diesel, and that should assist, in terms of a better network quality and also data and airtime usage. So we've also got a very attractive upside for MTN, 35% upside with a target price of 145 Rand. How do we see the macroeconomic environment playing out? And, I spoke a bit about the US and the Fed and monetary policy. The one theme that we're keeping a close eye on is oil and oil reduction and any disruption to oil. We've got very low inventory levels of oil in the US as they ran down their strategic oil reserve. And we have a very tight oil market. And that's been exacerbated by the likes of the whole theme and drive towards ESG. There's been a lack of investment in the oil industry, and the major producers such as Saudi Arabia and Russia have cut back on production. So any incremental demand in oil price is going to have a outsized impact on the oil supply. And what we're seeing is, any disruption will also be magnified. So some of the positioning in the portfolio is to act as a hedge against a higher oil price. I've mentioned Sasol, I've mentioned MTN. We have some of the global names in the portfolio, such as ExxonMobil, as well as EOG Resources, which are major oil plays listed in the US. And that gives us a hedge against higher oil prices. But on the back of that, higher oil prices don't bode well for inflation. And what we think, is that you're going to have US interest rates that are going to stay higher for longer as the Fed navigates the inflationary pressures and the drive towards a 2% level not being as fast as they thought it would be or expect it to be. And this will have, implications on the asset classes and positioning in the portfolio. On the back of that, bond yields are probably going to stay higher for longer. And, that makes it interesting from a asset class perspective, whereby 2 years ago, there was talk about TINA. There is no alternative to equities. Interest rates were very low, cash was yielding nothing, and equities was essentially the game in town. What we have now is, US interest rates or bond yields closer to that 5% level. They are alternative. Cash levels are much higher. And if you look at it, of the cash yield relative to the S&P earnings yield, cash is yielding you better returns. So from that perspective, it makes sense to have a higher weighting towards yield assets over these risk assets. The one other aspect that I would like to mention is China. What we've seen out of China is the recovery hasn't been as strong as what we anticipated it to be at the beginning of this year. And China has some structural issues in terms of an aging population, too much capacity in the housing sector and the property sector, and the normal playbook of China stimulating the economy via infrastructure spend is starting to wane. And China is also transitioning towards a consumer economy, which will take some time, but also they want to spend in those areas that are new age. For example, technology, chip manufacturing, renewable energy, and those sort of areas whereby they want to position the economy for the future. So what does that mean? China has done some sort of stimulus for the economy, but it hasn't been a big bang approach. And that has implications for commodities and the likes of some of the commodities that we as South Africa exports to China. For example, the platinum group metals, iron ore, those are probably going to be under pressure for longer. So essentially, one has to be very cognizant of which commodities you want to be exposed to and which ones are going to be structurally challenged. The other challenge from the EV vehicles that has an impact on platinum and palladium, whereby the demand is much less compared to an internal combustion engine. And again, that has implications for some of the stocks listed on the JSE, like Implats, and Northern and Sibanye as well. So what we're doing is, in the portfolio overall, we've got a higher exposure towards some of the rand hedges. We've upped our international and global exposure, and we've also upped our yield assets in anticipation of these factors that I mentioned earlier. So I'm going to leave it there. We'll take questions, and Verlin will facilitate that process.
Okay, thank you, Imti. Yeah, okay. That was a very quick rundown. Like I said, session is a shorter session that's aimed at just giving a quick look into what we're thinking, obviously in terms of macro, what we are looking at, what the potential implications and things like that are. So I would just like to ask Imti just one question that I think comes to mind regarding our process. We identified a contributor to the stock performance, and we identified a detractor to the stock performance. Can you just maybe elaborate on our use of machine learning to isolate certain sectors to inform our decision-making process? Because ultimately that's a part of our investment process as well. So how do we go through the sectors to see which sectors potentially add value and which sectors are potentially going to be detractors, so that informs our decision-making?
Thanks, Verlin. I think that's a good question. So what we employ at Sentio is a hybrid investment process. And by that, we use machine learning, artificial intelligence, combined with human experience to build portfolios that are robust from a risk management perspective, but also from a return perspective. So you want to optimize the risk return framework. What we do there is we feed a lot of variables into our process, both macro and micro variables. And essentially, the machine learning outcomes from that whole process guides us in terms of asset classes, styles, and factors that we should be focusing on. So, for example, currently the outcomes from that process is that we need to be still cautious in terms of our positioning, but in terms of the overall sectors and factors that we need to be focusing on, technology still screens quite well, value is screens quite well, and quality. What that essentially means is that, from a growth perspective, it looks like that playbook has been largely done. And the focus now is on better quality companies with stronger balance sheets and companies that are less cyclical in nature. And that's how we've been positioning the portfolio. From an overall perspective, we do think that the rand is going to stay weaker for longer. South Africa has its own challenges that we think will persist for a little while longer. We've got the medium-term budget policy statement on the 1st of November, and there's quite a bit of fiscal pressures that we're seeing overall come through, exacerbated by lower commodity prices, which leads to lower tax intake and ultimately higher funding needs by the government. So from an overall positioning level, less risk assets, more yield assets, but in the risk assets, one needs to focus on the quality counters over some of the cyclical counters.
Okay, that's a good answer. That answers a question for me. Just to inform everyone that's logged into the session, so Imti referred to quality. So Sentio as an asset manager is style agnostic. So that basically means we're not dictated by a style bias in terms of how we approach the investment process. So we would look at the business cycle and interrogate the cycle and understand whether the best style would be a value or a momentum or a quality or a growth style. And depending on what works best at any particular point in time, Sentio would use that type of investment style. So we are style agnostic. So we're not a value manager or a quality manager or anything like that. And that's why Sentio tends to blend well with a manager that has got a specific style according to which they manage. So we are a bit more flexible in terms of the business cycle and the interest rate cycle to take advantage of whatever is the best asset class to invest in. So Imtiaz mentioned that higher yields, for example, and more cash holdings and bond holdings as opposed to equity. So Sentio would do whatever is required in the portfolio, and Imti, you can correct me if I'm wrong, but to get the client to the specific benchmark and the outcome that is required in that portfolio. So we're not bound to a specific asset class split, and we will move in the market to produce the best outcome for the client in our portfolios according to the mandate. So if there are any questions.
I think it's an opportune time now to mention to whoever's joined us on this webinar that we have launched our Sentio Sharia Income Fund. This is now available. And this fund essentially is a fund that is targeting yield of, cash plus 10%. What does that mean? If cash is giving you 7%, we want to target 7.7. So essentially a higher level than just the cash rate. And this blends in very well with your consumers or investors who want an income producing asset without the volatility. Our fund is going to focus a lot on yield as opposed to capital. There could be from time to time some capital exposure that we will take in the fund, for example, some property and equity, but that's going to be very small and very opportunistic and quite limited. The essential outcome of the fund is to protect capital, give a return that is comparable, and it speaks very well to an investor who is looking for income, but also when an investor wants to take some exposure of risk assets such as equity or the balance fund, and they want to put it in an income producing asset, this fund will work very well from that perspective.
Yes, thank you, Imti. I was on the verge of mentioning the income fund, so we just got a question. Wasim, you're welcome to ask your question.
Awesome, thanks, guys. Imtiaz, I'm glad you actually brought up the income fund now, because that was going to be my question. I think that most of the Sharia compliant income funds are heavily invested into the sukuks, which if I look at the last, say, 3 years, or maybe even focus on the last year and a half, when interest rates have taken a massive spike, the income funds that are available at the moment have not necessarily perform to the standards that investors needed, especially when inflation has risen the way that it has. So
yeah.
we obviously talking about this being a better time for yielding assets over risk assets, and that makes sense. But from a Sharia compliant perspective, can we expect better returns from sukuks? I heard one of the other Sharia asset managers talk recently, and they said that they were tied into 5-year sukuks, which obviously was not yielding massive returns at this point, but we could see sort of better things coming. And then I also wanted to get your view of the possible government sukuk that is in talks, because that sounds extremely promising. And what's the likeliness of that? And is Sentio considering getting involved on that aspect as well?
Yeah. Thanks for that question, Wasim. I think very, very good questions. Just in terms of the performance of the other funds, I think what we have at our advantage is that we're starting the fund now, and what gives us an advantage is that we're able to take advantage of the higher rates. But also, we've been managing the sukuk portion in our balance funds for a number of years now. And our approach has been to take shorter duration exposure in the fund, because our view was that interest rates were on an upward path, and you don't want to lock in too much at lower rates. So we've actually done quite well if you look at it from a balance fund perspective in terms of getting exposure to the higher interest rates. As interest rates have increased, those sukuks and those yields have also ratcheted up. So we weren't locked into 5-year paper 5 years ago. We've been taking quite short duration exposure in the fund. And that's one of the advantages that we have. We have a very strong fixed income team, and they look at all of these various factors and try and manage the duration exposure with regards to the interest rate outlook. So we started investing the initial money in the income fund. We're getting rates on a 3-year basis at close to 10%, which is very attractive, we think, at this point in time. And we are starting to lock in these higher rates at these levels. Just in terms of the sovereign sukuk, we're quite excited. It is going to come to market, and it looks like it's going to come to market in the next few weeks. We are earmarking some funds for investment into that sovereign sukuk. The last one matured in 2017. We did have exposure to that one as well. And the returns are looking like they're going to be very attractive from that perspective. So it's a very high credit rating instrument. It's going to give you decent returns. And if you hold it to maturity, your total return is going to be very attractive. There is other types of instruments. The one is the agrarious sukuk, which is out there. That's also yielding very attractive returns, and we will be investing some into that. We already have exposure to agrarious in our balance Sharia income fund, and the income fund, the Sharia income fund, will also get some exposure to that. So our approach, I think some of the funds, as you mentioned out there, were certainly locked into the higher yielding paper, but there could be an element of exposure to risk assets, which also could have detracted from that performance. And we want to avoid that and make sure that our fund is more exposed to yield rather than capital.
Thank you, Imtiaz. And just in terms of, is there a potential timeline that we can expect the sort of government sukuk to come into play, or do we not yet know?
The latest indications is that it's going to be in the next 3 or 4 weeks. So let's call it the next month.
Okay, awesome. Shukran, Imtiaz.
Okay. Imti, thank you so much. There's a lot of good insight there, and thank you for the question, Wasim. There's some engagement there. Okay, ladies and gents, that's going to be it for the first of these sessions. We are going to do this on a monthly basis, and like I mentioned when we opened it, this is the first one. So if there were 1 or 2 glitches, please bear with us. Sentio is on an exciting trajectory in terms of building our retail brand and engaging with IFAs. And this is our way of getting in touch. We don't have a large retail BDM team at this point. So we do have to keep in touch with the IFAs in Cape Town, in Durban and Joburg by doing teams. We will see you in person, but please log into our next session. We will send you an invite to the next one, and we will catch up again in a month's time, see what's happened. The world is very volatile at this point in time. There's a lot of conflict going on. There's a lot of uncertainty. Economies are not panning out, and stimulus is not happening the way we want. So I think just check in a month's time, and then hopefully we've got some further information on our income fund, as well as its availability and the potential availability on all its platforms. So Imtiaz, thank you for your time. I know you're a busy portfolio manager with us. Saying thank you for taking the time to present this session. Guys, my contact details are on the screen. And if you have any questions, please drop me an email, or if you want to set up an appointment, please give me a call and we'll set up an appointment to discuss with you any of your further questions you may have. Yes, Wasim, we'll confirm that with you, which portfolios are available on that platform. But we do cover sort of all the larger platforms, Glacier, Old Mutual Wealth, we are now, and it's a work in progress. to get the platforms, our portfolios on all the platforms. So I've got a table, and I'll get back to you, Wasim, on that, on the portfolio availability. And that's it. So if there are not any questions, I'm going to wrap up the session. Thank you, guys. Have a good day further and all success. And peace be unto you from our side, and keep well and in good health. And we will see you in a month's time. Thank you, Imtiaz. Have a good day.
Thank you.